Hi, I'm Seth Freudberg. I'm the Director of Options Training here at SMBU in Manhattan, and I'm also the head trader of SMB's Options Trading Desk. So this week I'd like to talk about something I want to call a perfectly ineffective hedge. And let me tell you what I mean by that. Since the first of the year, as everybody knows, the market's sold off pretty hard, very scary. Some people are reminded of 2008. Some people are reminded of August 2011. We don't know exactly where this is going, but like any good trading desk, we're always looking for ways to improve, how to handle things better risk management, etc. And so we started looking at the possibility of buying some cheap weekly puts against the Russell 2000 index, which is the major index that we trade on our particular trading desk. And we decided to take a look at, hey, they're cheap options, they're puts, they last a week. It's not like buying a leap where it's going to be loaded with time premium. You'll have much less time premium over a week. And if something terrible happens overnight, you've got protection. So we took a look at that, and the results were a little surprising, let me put it that way. And I think they were so interesting and surprising, I wanted to share those results with everyone. So we did a real simple test. We took the last 62 weeks, and we bought a Russell 2000 index put at 5% below the market. So if the market was at 1,000, we'd buy the 950 put. And we also looked simultaneously at another put 7.5% away from the market. So we'd buy let's say the 925 put. And it was a trade that would last for 8 days. And basically we wanted to see, would it protect us? And here's what's pretty amazing about this. We ran the test for 62 weeks, and only one single week was that trade a profitable trade. 1 out of 62. It's unbelievable what a bad hedge that would have been. You would have, which means, by the way, you could have lost money on your trade and your hedge. And so I call this an almost perfectly ineffective hedge. It sounds great. Hey, 5%, market can move 5% pretty quickly. But what you will find is that it usually doesn't, and when it does, it doesn't mean it won't bounce back in enough time so that your option ends up worthless when it expires because the market's off 4.9% or 4.8%, not enough to give you any value at all in your put. So this is. Let me just say, I am absolutely convinced that buying weekly puts is a hopeless way to trade. And I want to, in terms of hedging your portfolio, it was worth a look, and I've quickly dispensed with the idea. And I want to remind you that included August of 2015, where we had sort of a second flash crash that occurred on August 24th. Nope, lost money that week. We also had September of 2014 that had an 8% drop during the month. No profit there. And even December of 2014, when we had a 7% drop, absolutely no value at all. If anyone's interested, the 1 week actually was in the last 3 weeks. And it did, if you were to look at the losses, it did cut the losses by about 25% this last week. But several of the weeks in 2016, the put did absolutely nothing despite the market tubing. So I'd like to ask you this question now. You can look at it as a hopeless hedge, or you can look at it as opportunity. Because if you had sold that put every one of those weeks as opposed to bought it, you would have ended up with a profit in every one but those 62 weeks. Now, would I do that? Would I allow someone to do that on our trading desk? No. We don't sell naked options on our trading desk, but we do allow people to sell credit spreads. We're doing that all day in lots of different ways. It turns out that every 5% away from the market option expired at a loss, and every 7.5% option expired at a loss as well, except for the one. So if you sold those two, if you sold the closer one as a short put, and you bought the farther one as a long put, in other words, a credit spread, you would have made a very, very nice profit in 2015 and early 2016 as well, even giving back a bunch of it in one of the early weeks of 2016. So, something to ponder. Might people want to look longer term, maybe go into your options analysis software and conduct a 10-year study? Take a look at that. 8 days from expiration, I went in on the Thursday for the options that expired the next Friday, and I just sold puts, or I should say bought puts, and the hedging power of these could not have been more disappointing. So therefore, maybe there's something there, something to look at. And these are the kinds of experiments you need to do all the time. Sometimes they come out counterintuitively, other times they come out as you expect, but you will always learn something by doing research and back testing. So I encourage it greatly, something to think about, and we'll see you next week. Let me remind you that this is the month of January, and we are running the John Locke 2016 M21 Challenge, in which we challenge anyone who has purchased some of John's products to purchase the remainder of the M21 series, so that you will have a comprehensive collection of the core teachings of John Locke, so to speak. We've put a very, very nice discount on the remaining pieces that you have not yet purchased, as well as provided 4 free webinars during the year for anyone taking advantage of this opportunity right now to go over these trades in more depth, to get some questions answered by John himself on a 2-hour webinar that will take place in February, as well as multiple webinars of individuals on our trading desk trading John's strategy. So it's a wonderful opportunity, and I encourage you to take advantage of it. Thank you.